Hello, today I'm going to fill you in on my full stocks and shares ISA portfolio. Now, I have been investing for 36 months straight. I achieved that milestone in November of 2024, and so I'm really excited to report on the progress of those investments and what it has returned to me. So before I dig in, I want to explain the portfolio, the platform that all of my investments are in. This is Vanguard, and back when I started 3 years ago, Vanguard really appealed to me as a platform, but I will say that as of January of this year, their minimum monthly fee has gone up, and so potentially if you've got a smaller amount of money ready to invest or you're a newer investor, then the £4 a month minimum may well be a higher proportion of your investment. Therefore, you may want to check out another provider. I do also hold a Trading 2 and 2 account, and to be honest, it was very easy to set up. So just, let me know actually if you would be interested in me doing a quick comparison of the different platform providers and to help you maybe with a quick start guide on how to get those registered. But anyway, mine's with Vanguard. You can probably find these funds on other platforms, so don't worry too much. That is just the place that I hold my personal investments. So I'm going to talk to you about the amount of money that I invested. And to be honest, over the years, I started in, I think it was December of 2021. I had a little bit less of disposable income back then to invest. And so over time, what you will see is that I invested more and more over the years. In year one, it was just over £4,000 overall that I invested. By year two, it was £6,000, and then by year three, it was £10,000. And so obviously on an average monthly basis, I was increasing those payments, and basically I caught the bug. I got really into investing and I started to try and put as much money as I could into these investments. And what I chose to invest in, I'm going to spill all of the detail. Obviously, you should feel free to invest in what you like, but I thought it might be useful for me to explain what I am invested in and why. So I've got 4 different funds that I am invested in, and I guess I'll go through in chronological order. So the very first fund that I put money into was the Vanguard Life Strategy 60% Equity Fund. Now this fund, I saw it as being a little bit less risky because it's split between equity, so shares, and also bonds. Bonds are known to be a little bit less volatile as they're not shares in companies, rather they are essentially like loaned out money, but that's not to say that they are not 100% risk-free. And to be honest, this fund was not my best performing fund either. And as I continue to invest, I also expanded and I did a few different funds. So shortly after doing the life strategy, I decided US equity was where I wanted to put my money. The US is a big portion of the global economy. I think it's about 2/3 of the global economy, and you'll have no doubt heard of the big tech companies which reside in the US and the Magnificent Seven. So a little bit of exposure to these companies is good. However, by doing something like going in a US equity fund, or you may choose something such as the S&P 500, it just means that your investment is split across many different organizations, and also it will adapt and change as the companies in the space will change, and therefore you're more diverse, and therefore you are less at risk of, say, following one company and then potentially losing it all if they go bust. So the US equity was actually my best performing investment over this time period. And I didn't have that from the very beginning, but I introduced that a little ways into my investment journey. The third one I'm going to talk about is the FTSE Global All Cap Fund. So I will show the details of this one on screen. And again, the more that I looked into things, the more I realized that actually, if you wanted to just be globally diverse, you could simply invest in one single fund that would give you exposure to all of the countries and all of the industries, etc. But I introduced this one into the mix because, again, I felt like it was going to help alleviate some of the bias that I already had within my portfolio. I'm aware I am probably well overexposed to the UK and also the US. However, I feel comfortable with this and I just wanted to throw in that all world element into my portfolio. And I did this again later on down the line, but I did start to invest quite a bit of my money into it. So again, I'm always investing on a monthly basis. That is the best way to ensure that you can ride out the highs and the lows and not get caught out on a downward trajectory. But yeah, I also like the all cap element because you've got companies of all shapes and sizes, and essentially if there's an underdog and they grow, you can kind of benefit from that too. So finally, this was a little bit of a punt, if I'm being honest, and probably shaped by my own personal experiences in the workplace and the sorts of companies that I have engaged with, but I have put a little small fraction of my money into the ESG Developed World Fund. And this one, to be honest, it may or may not make me money over the long term. I've seen both sides of ESG, so environmental, social, and governance. I've seen companies set net zero targets and appear very earnest in their goals, but then equally, I've seen that thrown by the wayside in favor of AI so that companies can maximize their profits and their revenue. And therefore, I think ESG is something that will not be an immediate priority. You've obviously seen what's happened in the US, but nevertheless, ESG may well still come back around. And so far, it has not lost me money. It's made me a little bit of money. And so I'm willing, given the small proportion that I have in that, I'm willing to ride it out and see what happens. But I also have a trainee actuary as a boyfriend, and he has crunched the numbers for me and double checked everything. And I'm very happy to report that over the 3-year period that we've been tracking, I've actually made a 15% return per annum on my money that I've invested. So I've invested in total across these funds that I have just spoken through £21,000. And at the height of the valuation, when I checked it in November of 2024, that my holdings were worth a combined total of 25,000. So immediately there, the unrealized return, I guess, is just shy of £4,000. I think that's a really good rate. I'm very pleased with it. And I also checked out what that would average to, because the really cool thing with stocks and shares and investing in the stock market is the passive returns you can get on your money. It's the only way I found thus far to give you a truly passive experience, and you can essentially set it and forget it. Now, I was going in and out over the months because I realized I had more money that I could put in and invest, and obviously to change those proportions, to change those payment amounts, I was going in and out and I was checking it. But to be honest, if you know what you want to invest, you can set that up. It'll be automated for you and you don't need to worry one bit. And something else I should also say is that all of the fees that I was charged on the platform are included in the calculation. So it's not any kind of hidden costs or any additional payments. What you will see on screen is the profit, the return that I have made, and that is inclusive of all of the fees and everything. So essentially that is the real return were I to cash out the investments. Now, I personally don't have any intention of cashing these out because I want it to snowball and compound over time. If you are wondering, how do I get started with this? I need to free up some money to even enable me to do this, or I don't know how much money I have spare. Please check out my other videos on saving money. I've got one really cool video about why, so getting you in the right frame of mind, and the other video is all about how and the logistics and the practical steps to take to start on that journey and what qualities you need to be able to make it a reality. But yeah, I mean, projecting forward, I believe I've stopped actually investing actively into this now, but it's sitting at around £25,000 in value. And looking back over the 36 months, based on the return that I have got, that was on average £100 a month in passive returns. But I can just imagine, like, if it was 10 times the amount that I had invested, so if one day I can make it to 250,000, that could be £1,000 a month passively. And, you're really getting somewhere with that. But anyway, where I am at right now today, because I've ceased contributing to this for the time being, based on our projections, which are relatively conservative at 8% return, we can safely assume that it's going to be making me £150 a month in passive returns. Now, again, we start small. That's not enough to cover my cost of living by any means, but nevertheless, it's a really good start, and it's nice to have that money doing something for me, and it will just be a great nest egg to come back to if I ever need it. It's in a tax-free wrapper, which means that I won't ever have to pay tax on it, so I can get it out in its entirety. It's just been a really good experience. I'm very, very happy with the return. What I would say as just a personal learning is definitely when you're going to start investing, ensure that you do so consistently and potentially on a frequent basis. What you don't want to do is just say you've got £20,000 and that will be your whole year's worth of ISA allowance. You don't want to chuck that right in necessarily at the start of the tax year, because what happens if the market value goes down for a time and then back up? You can't benefit from buying at those lower prices. And that's something that we personally saw happen for my whole first year of investing, the portfolio was in the red. I had not made a gain on the value of the portfolio. But because I was consistently buying and consistently investing, as this was going down in, I suppose it was 2021, I was buying at the bottomed out prices. I was buying as the value was going down, which then meant when the value went up, obviously I had made the most gains on those stocks and those shares that I had purchased when the valuation was quite low. Whereas if I had bought at the high point and then we saw a decline over the coming months, it would have obviously taken me longer to make a return. So yeah, just go for it. Go for diversity. Go for consistency. Go for set it and forget it, to be honest. And just be aware as well that the longer term that you are invested, the less risky it really becomes. Something that I feel most likely puts off a lot of people is the risk factor. So you're worried it's going to be very volatile. You're going to lose all of your money. And to be honest, it is volatile. If you're looking at it on a weekly or even monthly basis, you will see the numbers go up and down. The value of my portfolio today is different to the value of my portfolio in November. However, the longer duration you stretch this out, the more likely you are to make a profit. And as I said, in my first year, I had not yet got into the green, so I had not yet made a positive return. But to be honest, now 3 years in, I cannot imagine it dropping below the value that I have put in. And so really your best friend in this case is just to go in with the intention of keeping this money in as longer term as possible. And really, yeah, I think that's all I have to share with you on this topic. I just watched the video back, and thank goodness it only cut the very final thing I was going to say, which was thanks again for listening. I'll see you in the next video, and please do let me know if there's anything at all that you would like me to make content on. I'm really grateful for any interaction I get, so please do like, comment if you want to, subscribe, and I'll see you in the next video. Thanks.